So we are told in this question, that is April 2023, question number 2. I believe all of us have been able to get the question. So remember, part B of the question wants me to consolidate. So the question reads, River Limited operates in a fast-moving goods subsector. During the year ended 31st March 2023, River Limited expanded its operations by acquiring a controlling interest in 𝒖. So meaning that if we have a controlling interest, we're able to control 𝒖, then 𝒖 becomes our subsidiary. And a significant influence over the activities of Tutu Limited. So that means that Tutu, we simply have a significant influence, but we can't control it per se. All right? So Tutu becomes what we call an associate. The following draft financial statements for the year have been presented there. I can see statement of profit or loss. I can see statement of financial position given there. On 1st July 2022, River Limited acquired an 80% ordinary shareholding in 𝒖 Limited for a cash consideration of 1,100 million. 1,100 because the figures there are in shillings millions. The fair value of assets and liabilities of 𝒖 Limited were equal to their carrying amounts at the date of acquisition. The group policy is to measure the NCI at the proportionate share of net assets of the subsidiary at the date of acquisition. So the first thing, ladies and gentlemen, that I should be able to do there is to put up a group structure. Step number 1, give us a group structure. Give us a group structure. So in the group structure, we can see the big brother here is River. It's called River Limited. So we are told in note number 1, River Limited acquired 80% of 𝒖. So it has acquired 80% of 𝒖. So 80% is huge. 80%, this is more than 50%. This is more than 50%. So that means that 𝒖 is a subsidiary. 𝒖 is a subsidiary. Is there somebody who can help Mwalimu here by sharing the question? Yeah, anybody who can share the question? Lisa is saying that we did it. I doubt whether we did part B. Not unless you did it as homework. Part B, where they want us to consolidate, have we done it really? Lisa, are you sure you have done part B? Not yet. So you're doing consolidated statement of financial position. I don't want to skip that thing. Yeah, this is very, very important for you. Yeah, so please let's continue. So this is a subsidiary. And if it's a subsidiary, I will be interested in 2 key things. We have what we call the date of acquisition. Date of acquisition. When did we acquire 𝒖? We acquired 𝒖 on 1st July from note number 1, 2022. That is date of acquisition. How about date of financial statements? The date of the financial statements, ladies and gentlemen, date of the financial statements, if you look at these notes given here, the financial statements which are here, they are dated 31st March 2023. So is there somebody who can count for me the number of months? What we call the number of months. Anybody who can count for me the number of months? No? The number of months. If you count from July all the way to this one, so we have here July, August, September, October, November, December. Yeah, and then we come to the following year, January, February, the whole of March. So those are 9 months. NOM stands for number of months we stayed with the subsidiary in the year. And then note number 2, the group's policy is to measure NCI at their proportionate share of net assets of the subsidiary at the date of acquisition. All right. On 1st January 2023, River Limited acquired a 40% ordinary share capital in Tutu Limited for a cash consideration of 500. But River never stopped there. River went ahead and acquired 40% of Tutu. 40% of Tutu. You see, 40% falls in which class? falls in this category, 20% all the way to 49.99%. Yeah, if you remember this category shareholding, we normally give it a special term known as who? Known as an associate. Known as an associate. Yeah, so in this case here, please know the date of acquisition. When did we acquire this associate? Note number 3, it's 1st January 2023. 1st January 2023. How about the date of the financial statements given in the question? Given the question is 31st March 2023. So then are you able to count the number of months? Are you able to count the number of months that we stayed with this associate? Anybody who is able to count the number of months we stayed with this associate in the financial year? It is only 3. It's only 3. Now, ladies and gentlemen, having gotten this very, very nicely, we know the second step. Whenever it comes to consolidating the statement of financial position, the second step, there is no way we'll be able to progress without knowing the net assets. We'd want to know the net assets of the subsidiary. We'd want to know the net assets, not of the associate, but of the subsidiary. So please go ahead and give me the net assets of the subsidiary. Give me the net assets of the subsidiary. Give me the net assets of the subsidiary. So step number 2, give me the net assets of the subsidiary known as 𝑠𝑖. Now, as I progress, remember net assets are exactly equivalent to what we call equity. What we call equity. Yeah, in the balance sheet, this is what we call equity. And remember this equity, you must give us the equity at the date of acquisition, and then we have here at reporting. Now, is there a good student who is able to remind me the equity components? Any good student who can remind me the equity components? Equity components? Any good student who can remind Mwalimu here the equity components? Thank you so much, Elvina. Share capital. I can see share capital. Thank you very much. So share capital will be there. Like in this question, is there somebody who can read for me the share capital? The share capital of the subsidiary. The share capital of 𝑠𝑖. Remember share capital, share premium, I told you, those are the items which don't dance. Those items that don't fluctuate. Yani zile items ziko na kiuno ngumu kama accountant. Yeah, so in this case here, share capital of 𝑠𝑖, if I look at the balance sheet given, you'll be able to see under equity and liabilities. Ordinary share capital of 𝑠𝑖. Is there somebody who is able to see that? It's 500, isn't it? So it will be 500 at acquisition and 500 at reporting. And you are right. The next item I can see there is share premium. Share premium will also not fluctuate. So the share premium that we have, ladies and gentlemen, the share premium amount that we have, ladies and gentlemen, is how much? Remember, it is for the middle company. For the middle company, ladies and gentlemen, share capital is what here? Share premium, share premium. Share premium is what, ladies and gentlemen? I can't see you guys talking to me there. What is the value of the share premium in this particular case here, ladies and gentlemen? 200, and this never fluctuates. So 200 at acquisition, and then we have 200 at reporting. Yeah, and then now remember, we have retained earnings. Retained earnings of 𝑠𝑖. I can only see the figure of retained earnings, which was reported. Retained earnings reported. Is there somebody who can see the retained earnings reported? You have to be very, very careful. Yeah, same as retained profit. So retained profit for 𝑠𝑖, the middle one, which was reported is how much? The middle one, the one that was reported is how much? It is 800. This is what was reported. How about retained earnings at acquisition? When we acquired this subsidiary, retained earnings, of course, will be different. In most cases, the examiner will tell you that when you are acquiring 𝑠𝑖, it had a retained earnings of, say, 300. In most cases, they will tell you. But in this question, they had hidden that figure. Even if they hide it, no problem, no problem. remember, we are doing this financial reporting on 31st March 2023. Yeah. So then we have here 1st of April 2022, beginning date of the year. Yeah. And then remember that we acquired the 𝑠𝒑 on 1st July 2022. 1st July 2022. So you told me that these are 9 months. So this will be 3 months. That's what you guys told me. From the date we acquired to the date of reporting, date of financial statements, we have 9 months in between there. 9 months in between there. Fortunately, we know the retained earnings we reported here were 800. Retained earnings reported were 800. So what we need to do is to ask ourselves, between here and here for 𝒑, do we know the profit after tax for the whole year? Do we know the profit after tax for the whole year for 𝒑? Because profit after tax is what will be going to the retained earnings reported. Is there somebody who can look at the income statement of 𝒑 and give me the profit after tax? Give me the profit after tax, profit of the year, profit for the year for 𝒑 Limited. It's 400, isn't it? But you see, this 400 is for 12 months. Is for 12 months. Then what will be the profit for 9 months? So the profit for 9 months here will be 9 over 12 times 400. So between here and here, how much do we have there? Yeah. Remember, I want to look at the profit for the 9 months. Profit for the 9 months. So this one here will be equal to what? Your profit for the 9 months. I'm being told it is 300, isn't it? I'm being told it's 300. I'm being told it's 300. Then, ladies and gentlemen, retained earnings at acquisition, which is my X. So retained earnings at acquisition, which is my X, plus this 300, plus this 300 for 9 months, should be equal to retained earnings at reporting, which is 800. Should be equal to retained earnings at reporting, which is 800. So can somebody in this case here give me this retained earnings at acquisition? Profit after tax? Yeah. You see, if you look at the income statement for 𝒑 at the middle, 𝒑 Limited, the profit for the year was 400. Profit for the year was 400. And nothing was paid out of this 400 as dividends. So the whole amount will be assumed to be retained. Will be assumed to be retained. So the 400, the whole amount, of course, it has to be time apportioned because 400 is for a whole year. It's for a whole year. It's for a whole year. So then this one here means that the retained earnings at acquisition were 500. 500. 500. I mean, so many guys will do this in very different ways. You will get somebody saying that this profit after tax of 400 is for a whole year. How about 9 months? Then they tell you that 9 months is 300. Once they have known that, they will easily give you these retained earnings at acquisition. How? They know here we are moving back. So if we are moving back, we are always subtracting. So I will say it is 800 minus that 300 because we are moving back. Yeah, which gives us what here? Which gives us that 500. Which gives us that 500 as our retained earnings on the date of what year? Acquisition. So you can see retained earnings, the figures will always be different. The figures will always be different. Now, is there any other component of equity that you guys think we should bring here? Any other component of equity? Any other component of equity? For example, we have what we call fair value adjustments. When we have revaluations, in this question, there was nothing like revaluations. Then we have what we call unrealized profits on stock. If the subsidiary did make the sale, yeah, unrealized profit on stock, if the subsidiary made the sale. Let's look at note number 4. We get to see who sold these goods, note number 4. During the post-acquisition period, River Limited sold goods to 𝒖. So River, the parent, sold goods to 𝒖. Then that cannot affect us at all, because that is what we call downward, downstream. The parent sold to the subsidiary. It would have been an issue here if, ladies and gentlemen, the subsidiary is the one that sold. Yeah, so in this case here, this one, I will be able to leave out any unrealized profits on stock. Now, in this question, remember we are done the question, that is why I'm moving a little bit fast. We are done it, especially the first part. We have what we call depreciation overcharge. Yeah, depreciation overcharge. So this depreciation overcharge, remember, comes, why? Because the subsidiary owns the asset. The subsidiary owns the asset. Depreciation overcharge, why? Because this asset that was over depreciated is owned by the subsidiary. And this has been given in note number 6. Note number 6. Note number 6, you can write there depreciation overcharge, note number 6. On 1st October 2022, River Limited sold an assembly plant to 𝒖 Limited. So who owns the plant? It is 𝒖, because now 𝒖 is the one that received. So for fixed assets transfers, you have to be very, very careful. Yeah. So in this case here, we are told on 1st October 2022, River Limited sold an assembly plant to 𝒖 Limited for shillings 400 million, reporting a 25% profit margin on the selling price, and netted off the profit against its cost of what here? Cost of sales. So not a problem. So I'm looking for what we call unrealized profits on fixed assets. Yeah, unrealized profit on fixed asset. Yeah, unrealized profit on fixed assets. How will I be able to get this? I will take the profit margin times, I will take the profit margin times what we call remaining intra-sales, times remaining intra-sales. Remember, the whole of this assembly plant had not been sold. For you, PFA is very, very easy, and realized profits on stock is what you'll be able to consider those left. But here you see the whole fixed asset is left within the organization. The profit margin is 25%. All right, times the remaining intra-sales, the asset transferred in between is what? 400. The asset transferred in between is what? 400. So then can you kindly give me this unrealized profits on fixed assets? Unrealized profits on fixed assets. So they're saying that the video has a problem, I don't know. Unrealized profits on fixed assets. Yeah, they want me to explain something there. I will be able to explain. So unrealized profits on fixed assets, I'm told this is 100. This is 100. So you can imagine we are holding an asset, which in this case here, somebody sold to us within the group at a profit. That is fake profit. So basically our asset is overvalued. And because of this overvaluation of the asset, we shall have what we call a depreciation overcharge. We shall have what we call a depreciation overcharge. A depreciation overcharge. So have they given us the rate of depreciation? Oh yes, they have told us, if you look at this note number 6, last sentence, they told us the group charges depreciation on plant at the rate of 20% per annum on cost. 20% for a whole year. So 20% over 100, which gives me 20 bob. Remember, even if you stayed with this asset for only 3 months, the policy is that you charge, first year you charge the whole year. They have told us in this note number 6, the last paragraph, the last sentence, the group charges depreciation on plant at the rate of 20% per annum on cost. on full year basis on the year of asset purchase. So this depreciation overcharge, because you see it was charged on the who? On the subsidiary. It was subtracted from, of course, the asset. It was subtracted from the asset erroneously. They should not have done that. So in this case, I shall be able to receive it as an equity positive figure. And that is it. Go ahead and give me these total net assets. Go ahead and give me these total net assets, as I repeat, something on retained earnings. Oh, I minimize the screen, eh? You want me to minimize my screen? Do you want me to minimize my screen? Do you want me to minimize my screen? Video not clear. Oh, okay. Oh, it's not on my side, eh? It's not on my side. So could you kindly then give me this net assets at acquisition, how much? And at reporting, how much? Please give me this. Please give me this. It's okay. Thank you so much. So 𝑹𝑪𝑴, she's giving me 1,200. 𝑹𝑪𝑴 is giving me 1,200 here. 𝑹𝑪𝑴 is giving me 1,200. So remember the depreciation overcharge, you add it, eh? You add it back. Add it back. Yeah, 1,200. At reporting is 1,520, eh? I don't know how, Lillian, you got 1,700. I don't know how you got 1,700. Please check. Please check. Because most of you are saying it's 1,520. 1,520. And then now you'll be able to give us what we call total post-acquisition profit. Yeah, the total post-acquisition, what shall be abbreviating as PAP, eh? Even in your exam, you abbreviate like that, PAP. So it will be the difference between the two numbers, 1,520 minus 1,200, which gives me 300 and what here? Which gives me 320, which gives me 320. 320. Now, ladies and gentlemen, leave that there. Don't even apportion it. Just leave it like that. Leave it like that. But before I proceed, a student has asked me to repeat on this concept of retained earnings. Repeat on the concept of retained earnings. Retained earnings at the beginning. So remember, at reporting in the financial statements given the statement of financial position as at 31st March 2023, you can see the retained profit and equity. For the subsidiary, it was 800. 800. So that's what we call retained earnings at reporting. At reporting is 800. And then you come and give us the profit for the year. The profit for the year for the subsidiary. Go to the income statement given there. Go to the income statement given there. 𝑠𝑖 for the subsidiary, it was 400. It was 400. It was 400. So this is profit for the whole year. But now remember, we must time apportion this. The subsidiary was only ours for 9 months. So 9 months profit, 9 months profit, 9 months profit will be 9 over 12 times this 400. That's how we got 300. In this case here, to be able to get now what we call retained earnings at acquisition, which will be smaller, we deduct. That's how we got what here? That's how we got that 500. That's how we got the 500. Now, Isabel is asking, yeah, why not consider 3 months? And Isabel is asking, how 400? Isabel, it's given there. If you look at 𝑠𝑖 Limited, that paper, you'll be able to see profit for the whole year was 400, Isabel. 400. 400. Yeah. The profit is in the question. It's given. 𝑠𝑖 Limited. If you look at the statement of profit or loss for the year ended at the 1st March 2023, it was 400. It was 400. Now, how about in this case here, since we acquired at 3 months into the year? Okay. Why not, in this case here, 3? Let me just demonstrate this using a number line. So at reporting, 800. So we acquired this farm, if you remember, so we acquired this farm here 3 months, eh? But we stayed with it for how many months? For 9 months. So these 9 months, this is where we made 300 bob. You see, look at the mathematics here. We are trying to ask ourselves, what is this number? What will be the value of this number? This number, which is x, plus this 300, because you see, we were here at x. We generated 300 and we kept everything. We retained everything. So x plus 300 should be equal to 800. So this cannot really come anywhere in the picture. That cannot come anywhere in the picture. So it will be x will be equal to 500. And because we are looking at our profit, remember, this is what we call pre-acquisition. Pre-acquisition profit is not ours. The profit that we are going to take into our retained earnings basket is what belongs to us. It is the post-acquisition, after acquisition. Now, ladies and gentlemen, after that, now I'll be able to go to the next working, because I want to do balance sheet now. I'll be able to go to goodwill. Goodwill. So remember, for goodwill, you give us the consideration paid by parent. Then you give us consideration paid by non-controlling interests. Consideration paid by non-controlling interests. Consideration paid by non-controlling interests. And then we'll be able to come here and less net assets. You less net assets at acquisition, like that. And then you'll be able to get your goodwill. Your goodwill. So goodwill. So goodwill will be consideration paid by the parent. How much did the parent pay? You write. Then you ask yourself, remember the parent in this question, the parent has 80%. If you remember very well, note number 1, 𝒖, we only acquired 80% of 𝒖. So if this is River, which has acquired 80% of 𝒖, yeah, it means that River is the parent, but there must be another owner who has 20%. This other owner who has 20% to make it 100 is what we call non-controlling interest. Is what we call non-controlling interest. Non-controlling interest. Yeah, this board has a problem. I think this board has a problem. So many people are complaining that they can't complain for nothing. They can't complain for nothing. So many people are complaining. They can't complain for nothing. There must be a reason. They can't complain for nothing. There must be a reason. Hapo sasa, right? At least there. Now, so in this question, are you able to see like how much in this case, ladies and gentlemen, how much, ladies and gentlemen, was paid by the parent? How much was paid by the parent? So note number 1, we can see on 1st July 2022, River Limited acquired an 80% ordinary shareholding in 𝒖 Limited for a cash consideration of 1,100. So consideration paid by the parent. So consideration paid by the parent, 1,100. How about consideration paid by non-controlling interests? They have told us in note number 2, the group policy is to measure NCI at their proportionate share of net assets of the subsidiary at the date of acquisition. So meaning that, ladies and gentlemen, they are not using full method. They haven't given us how much, to be precise, the NCI paid. So they're not using full method. No. So in this case here, this goodwill, we are using what we call partial method. Partial method. Why partial method? Because the value of the NCI has not been given. It's partial method because value of NCI has not been given. So we shall leave that value of NCI like that. Then come and give me net assets at acquisition From the working that we have just done up there, how much is the net assets at acquisition? How much is the net assets at acquisition? 1,200, right? So we have here 1,200, 1,200. So then the NCI is going to get, their share of these net assets. Do you remember the NCI's percentage? Do you remember the NCI's percentage? Do you remember the NCI's percentage? NCI's percentage? 20%, isn't it? Is it 25 or 20? 20%. So remember now, the NCI is getting 20% of the total assets here. Total net assets, 1,200. So 20% of 1,200, this will end up giving me how much? 20% of 1,200 will end up giving me how much? 960? No, 240. That will give me 240, and that is it. So you subtract, you'll be able to give us goodwill at acquisition. You'll be able to give us goodwill at acquisition. Are you able to give me that goodwill at acquisition? So you take this 1,100 plus 240 minus 1,200. Tell me, what are we getting there? Yeah, 1,100. So goodwill is 140. 140. Impairment loss, 0. The goodwill was not impaired at all. So then the goodwill, we shall report goodwill at reporting. Goodwill at reporting will be exactly 100 and what here? 140. Goodwill at reporting will be 140. Yeah. So are you able to follow somehow, ladies and gentlemen? Are you able to follow somehow, ladies and gentlemen? Are you able to follow somehow, ladies and gentlemen? Are you able to follow somehow? At least I'm getting Elvina saying yes. How about the other ninjas? Are they able to follow? Yeah. Remember, there is another method. Some other students will tell you, hey, no, we don't want that method. And then I'll tell them, no problem. We have another method. So remember, this is April 2023, question number 2. So method 2. So under method 2, somebody will tell you, hey, this is partial method. So then if it's partial method, let's just consider the consideration paid by parent only, 1,100. So we don't bring in any NCI because NCI value has not been given. So then you come under less net assets acquired. Net assets acquired. So the net assets acquired, if you're using this approach, remember the net assets acquired were 1,200. But now we'll only consider the net assets of the parent only. Net assets of the parent only. 80% of 1,200. Yeah. So what is 80% of 1,200, ladies and gentlemen? 80% of 1,200. Yeah. 80% of 960. 960. So if you do it this way, I believe you'll be able to get that goodwill. Goodwill at acquisition, which will be the same as goodwill at reporting. We call this one partial method. You're only looking at one stakeholder. You're only looking at one stakeholder. So the choice is really yours. The choice is yours. The choice is yours. Although still you have to know both of them, because now when we go to the next working will be non-controlling interests. The next working will be non-controlling interests, which is basically our last working, because we normally don't do group retained earnings. So non-controlling interests, you give us what we call NCI at acquisition. The figure that you used to compute goodwill, the figure of NCI that you used to compute goodwill is what you bring here. Remember the goodwill that we did there using method 1. It was 20% of 1,200. This NCI at acquisition, it was 240. 240. And then you add share of PAP, share of post-acquisition profit. Is there somebody who is able to remember what we got as our total post-acquisition profit? Anybody who is able to remember what we got as our total post-acquisition profit? It was 320. And remember, these guys, they only own what percentage? 20%. They only have 20%. These guys have just 20%, which gives us how much, ladies and gentlemen? Which gives us how much, ladies and gentlemen? Yeah, Isabel is floating. Perhaps, Isabel, today is your first class. Today could be your first class. Yeah, you need to watch videos a bit. You need to watch videos a bit. But I hope it's not like all of you who are floating. If all of you are floating, then that will be very disastrous. That will be disastrous. So I'm being given a figure of 60 watt here, a figure of 64. So in this case here, then what is NCI at reporting? You add. So NCI at reporting will be how much? 3 or 4, right? 3 or 4. NCI at reporting will be 3 or 4. So please don't do retained earnings, group retained earnings. No. Now go ahead and consolidate. So go ahead and do the consolidation. So you write there. Now you write there, River Group, consolidated, statement of financial position as at 31st March 2023. 31st March 23. You write like that. Then you start with assets. So we have here non-current assets. Non-current assets. So non-current assets, are you able to see them? You are consolidating. To consolidate is to put together. To consolidate is to put together. You are adding. And remember, you add parent plus subsidiary. You add parent plus subsidiary. You don't bring in any associate. So it is parent plus subsidiary. So don't bring in issues of 2-2. So we start with property, plant, and equipment. So property, plant, and equipment. Yeah, why are we not doing group retained earnings? I told you from the beginning that group retained earnings as a shortcut. You know, these workings will not give you like any marks. If you get a shorter way of doing them, the better. The better. Because you see, you are supposed to do the whole question in how many minutes? 37 minutes. That's why I'll be showing you what we call low-hanging fruits. Yeah, I'll be showing you what we call low-hanging fruits later. So we start consolidation. So property, plant, and equipment. So property, plant, and equipment, what do we have here? So the PPE that we have here, property, plant, and equipment that we have here, I can see 2070. Are you able to see that figure? 2070 plus for the one of the subsidiary. So 2070 plus the one of the subsidiary, which is what here? 1290 plus 1290. But do you remember that we had some fake profit within this? Unrealized profit. Yeah. So in this case here, minus 100, which is the UPFA. And then remember, there was a depreciation overcharge. Yeah, which you need to return back. There was a depreciation overcharge that we need to return back. And remember, we're only taking figures of who? Figures of River and Sai. 2-2, we don't consolidate associates. Associate is quite distant, cousin. Yeah, that's an outsider. Yeah. So they're giving me final figure. The final figure in this case is supposed to be how much? The final figure is supposed to be how much? $32.80. I'm being given a figure of $32.80. And again, remember, for the consolidated balance sheet, you don't say times 9/12, because for the balance sheet, we are looking at the end of the year, what belongs to us. We are controlling everything at the end of the year, what belongs to us. So we are controlling everything there. So in this case here, they're giving me $32.80. Then we have investments. Of course, the investments that we have here is the investment in subsidiary and the investment in associate. Let me ask you a question. Are we going to write here investment in a subsidiary? Are you going to write investment in our subsidiary? No. In its place, what are we going to have? What are we going to have in its place? Because you see, subsidiary is your wife. For those of you who have got women here, who have got wives here, if you take them to school, you can't claim that investment. That is yourself. You can only eat fruits of goodwill, isn't it? You can only eat fruits of goodwill. Goodwill. And the goodwill already we have the figure. Is there somebody who can remind us what the figure is? 140. And then now we have the other investment is investment in associate. In associate. So investment in associate, what do? We look at investment in associate. You look at the cost of 22. How much do we pay to acquire 22? How much do we pay to acquire 22? How much do we pay to acquire 22? This 22 thing, how much do we pay to acquire it? 22 thing. It is in note number 3. On 1st January, River Limited acquired 40% shareholding in 22. Yeah. For how much? For 500. 500. And then now you come and add share of PAP. But now for the associate. For the associate. Remember the associate, can somebody remind me? How many months do we stay with this associate in the year? From your group structure. How many months do we stay with the associate? 3 months, isn't it? And are you able to see 22's profit from the income statement? Are you able to see 22's profit? Are you able to see 22's profit from the income statement? From the income statement, are you able to see 22's profit? It is 200, isn't it? So we are able to see 22's profit is 200. So then in that case here, ladies and gentlemen, I will be able to take 200 for the whole year, but you see we were only with 22 for 3 months. So times 3 over 12, and remember, this is 100%, but our 22's percentage was 40. Our 22's percentage was 40. Can somebody in this case here give me this investment in our associate? So 200 times 3 over 12 times 40%. Is there somebody who can give us this figure? Is there somebody who can give us this figure? 20, eh? So they're giving me a figure of 20. It means that this investment in associate is 520, and therefore give me the total non-current assets. Give me the total non-current assets. Give me the total non-current assets, the 3 figures. Just add them up. Give me the total non-current assets, those 3 figures. Please add them up. Total non-current assets, 3940. 3940. And then now, ladies and gentlemen, please come and add in this case here now the current assets. I will remember that figure. I will remember that figure. Don't rub yours like the way I'm rubbing mine. Yeah, I will remember that figure very well. I will remember this figure very well. So now we go to the section of current assets. So we go to the section of current assets. So current assets, you simply pick them. We start with inventory. So current assets, we start with inventory. Inventory. So inventory, you take the one over the group. Only group is parent plus subsidiary. So you take the one over River, which is 530, plus the one over the associate, which is 390. But for the inventory, I must make some adjustment. Is there somebody who will tell me what adjustment will I make for inventory? Which adjustment will I make for inventory? Because it is overstated, there is some adjustment. Thank you so much, Anne Karaoke. I should be able to give you something. You are the first one. So come and subtract UPS. And we are done UPS for this question in our last class. Is there somebody who can remember what this unrealized profits on stock was? Anybody who can remember what the unrealized profit? Njoki is giving me a figure of 30. Just that. Because IS2 tells us that stock cannot have a profit in it. So take 530 plus 390 minus 30. Please give me a figure I write here. Please give me a figure I write here. So inventory, you add the one of the parent plus the one of the subsidiary, and then you take away the unrealized profits on stock. The students who are joining us today, you are a little bit disadvantaged, but don't worry. I'll be able to give you a solution. Don't worry. You should never be worried there. Now, ladies and gentlemen, from there, the next item to be consolidated there under current assets is what we call receivables. Receivables. To consolidate is to add. Take the figure of the parent. The figure of the parent, therefore, receivables is 640 plus 470 subsidiary. Can somebody tell me what am I going to adjust this with? Receivables. There must be something that I'm going to adjust this with. There must be something. Cash in transit, not under receivables. There is something, but at least you guys are trying. You guys are trying. Yeah, payables is another section, but thanks for trying. If you look at note number 5, included in the trade receivables of River Limited was 80 million due from 𝒖 Limited. Who is 𝒖? Who is River? These are related companies. 𝒖 is the parent, and rather River is the parent. 𝒖 is part of, is sub 80. So you see that 80 is fake receivable. I gave you an example of my wife. If my wife tells me, Mwalimu, give me 100,000, I would rather, after I've given her that 100,000, I can never put it in my receivables book. That's fake receivable. I will never get it back. So minus 80 like that. So could you kindly give me this consolidated receivable? Please give me this. Yeah, thank you, Millie. Give me this consolidated receivable. Yeah, give me this consolidated receivable. And then I'm going to do another abracadabra because I'm told that there is a 60 payable. I'll do some other abracadabra there. So in this case, I'm being given a figure of 10 what here? I'm being given a figure of 1030. I'm being given a figure of 1030. I'll be able to do some other abracadabra, don't worry. And then we have financial assets at fair value. Financial assets at fair value. Financial assets at fair value, no adjustments at all. This is normally free mark. This is normally a low-hanging fruit. Financial assets at fair value, I will take the one of the parent plus the one of the subsidiary, which gives me 400 what here, which gives me 450, like that. Yeah, 450. Yeah, 450. After that, ladies and gentlemen, we still have some other. We have here cash and the bank balances. So we have here cash at bank. Cash at bank. Now, Chris, this is where you think about the CIT. So cash at bank, I can see the parent is 360 plus the subsidiary is 200. Now, remember, these two companies are funny. So we have here River, and then we have 𝒖. We have 𝒖. Now, these companies are funny. We are told in note number 4, note number 5 actually, included in the trade receivables of River Limited is 80 million due from 𝒖. Yeah, tuendelee sasa hapo kizungu. Yeah, and then in the books of 𝒖 Limited, the amount due to River Limited was shown at 60. Yeah, so in this case here, to River is 60. Is 60. Meaning what? That, it's supposed to be 80-80. Meaning that 𝒖 has sent some money, but River has not yet received that money. So there is what we call cash in what year? Cash in transit, yes. There is cash in transit. Over how much, somebody there? Of 20. There is cash in transit of 20. They have told us there is cash in transit of 20 because 𝒖 Limited had remitted the 20 million, but River had not recorded. So we have 20 there. So it will be 360 plus 200 plus cash in transit, which in this case here, nobody is able to see it. But now because we are looking at the group accounts, group is bigger, group is stronger, group will see cash in transit. So then can you kindly give me this? Cash at bank, total, how much? Cash at bank, total, how much do we have there? Cash at bank, total, how much do we have here? 580, and that is it. So come here and give me my total assets. Total assets. Don't forget the non-current assets that Mwalimu rubbed his. Remember, I rubbed my non-current assets, and if I remember very well, my non-current assets here were 3940. So please remember, we have the 3940 here. So please come and add everything for you to give me the total assets here. Add everything for you to give me the total assets. So according to these friends of mine, it's supposed to be 6890 Total assets supposed to be 6890, double underline that figure. Total assets supposed to be 6890, double underline that figure. Double underline that figure. Is that okay, ladies and gentlemen? Yeah, so 6890. So from there, ladies and gentlemen, you go now to the equity. Go to the equity. Go to the equity section. So equity, you shall start with share capital. So remember, it's equity and liabilities, but start with equity. So start with share capital. Start with share capital. What do you know about share capital in group accounts? Is there somebody who has an idea? Share capital in group accounts, what should I do? Share capital in group accounts, what should I do? Share capital, only parent. Grace Paul, great. Parent, and here we don't have any share exchange. We are very lucky. Parent only. Parent only, and of which I can see, ladies and gentlemen, here, the share capital here is 2,500 for the parent only, for 𝑠ci only. The same will apply to the share premium. Share premium. So share premium for the parent only. For the parent only. So share premium for the parent only. How much do we have there? Share premium for the parent only. I can't see very well, but we shall overcome. 500. 500. Great, great, great. And then we have in this case here, retained earnings at reporting. This is the worst working. This shall always be the balancing figure. When you complete everything, you shall always have this as the balancing figure. Balancing figure. Yeah, that we shall not do. Is there any other equity component you think will be important for us to bring here? Any other permanent source of capital that you think we should be able to bring here? Non-controlling interest. Thank you very much. NCI. And do we have this NCI ourselves? Yes, we are done NCI. And we got 304. We got 304. We are done NCI, we got 304. From there, ladies and gentlemen, now go to the liabilities, of which you start with non-current liabilities. Non-current liabilities. So non-current liabilities, I can see 12.5% loan notes. So 12.5% loan notes. No adjustment at all. Very easy. So we have 640 plus 480. 640 plus 480, which gives me what figure? 640 plus 480, this gives me what figure? Non-controlling interest, yeah. 3304, no. Don't add because there is some figure too. So this is 1120. This free marks. From there we have deferred tax. Free marks again. Deferred tax, no changes. So deferred tax will simply come and take 260 plus 100. 260 plus 100, which will end up giving me 360 like that. Yeah. Now from there, ladies and gentlemen, we go to the current liabilities. Let's go to the current liabilities. Let's go to the current liabilities. Current liabilities. So under current liabilities, what do we have under current liabilities, my good students? Under current liabilities. So under current liabilities, we have trade payables. Current liabilities, we have payables. So payables, we have a figure of 420 plus 330 to consolidate, but I must do some adjustment. Is there somebody who can tell me what the adjustment will be here? Fake payable, who is this? This 𝒂𝐈𝐅𝐾 is a serious 60. Thank you, Lillian. Subtract not 80, but 60. There is a fake payable. There is a fake payable there of 60, which will end up giving me how much? Which will end up giving me how much? Thank you, RCM Publishers. So I'm being told that it is 690. 690. And then I have, ladies and gentlemen, the tax issue. The tax. So for taxation, we have 160 plus 90. So no adjustments normally. No adjustments normally. No adjustments normally. So 160 plus 90, that will be 250. 250. So then when you add everything, we should be able to get the same figure with total assets. Total assets, which was what here? If you remember, total assets was 6890. Total assets was 6890. You remember that figure? Total assets were 6890. Do you remember that figure, ladies and gentlemen? Do you remember that figure of 6890 total assets up there, the one you have financing? And if you are able to remember, then now you work backwards. 6890 minus this, minus this, minus this, minus this, minus this, minus this, minus this. You'll be able to get the figure of retained earnings here. You'll be able to get the figure of retained earnings. So you take this, minus 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 that. Then you'll be able to give me the figure of retained earnings. So in this case here, according to 𝑹𝑪𝑴 𝑶𝒏𝒍𝒊𝒏𝒆, retained earnings is supposed to be 11 what year? 1170. 1166. Check, check. 1166. 1166. And that is the end of that question. That is the end of that question.